Hi everyone, welcome back. Today's video is all about investing in the stock market. I know that many of you have been waiting for this video for quite some time. This is going to be a basics video, a 101 type of video. So we're not going to get into all the complicated financial jargon. I'm not going to talk about all the advanced options for investing in the stock market. We're purely going to talk about getting started and what the differences are between investing in individual shares versus funds versus ETFs, okay? So let's get started here, and I have my chai latte sitting out. My goal is to make this video quick and dirty, and I want to make sure that I'm finished with this video before the ice melts in my drink. That's my goal here. Okay, so there are really two ways to get into the stock market. First of all, you have to have an account where you can trade. If you can do that through your 401k or through IRA, beautiful, because those are tax advantaged accounts, so you will save money on taxes. But let's say you've already maxed those out or those are not available to you for whatever reason, then you just need to open a brokerage account. Now, a brokerage account does not have the tax advantages, but they will allow you to trade, okay? So for me personally, I have maxed out all of my retirement accounts, 401k, IRAs, and so what I do is I also have a brokerage account and I will trade there. But there are two basic ways to get into the stock market. One is through individual shares. So if you were to say, I want to invest in LVMH, which I did a while ago, and then I sold them all off, made a nice profit, or funds. Okay? Individual shares are straightforward. You say to yourself, I want to invest in Target or McDonald's or Google. For whatever reason, you've studied the financials and you feel that this would be a good investment for you, or it's a brand or a company that you personally support and stand by. Whatever the reason, part of it is going to be logic and part of it is going to be just emotion. Let's be honest here. And the stock market in general is pretty much a gamble. Sometimes the prices will go up for no reason and sometimes they will drop for no reason. Other times there will be obvious financial reasons. For example, if a company misses their sales targets or they just release their reports and the market is responding to that, fine. But a lot of times it's just purely illogical because there are human beings behind the stock market, okay? So like I said, it is a bit of a gamble. So you have to be able to have some risk tolerance and to be able to stomach the volatility of what happens in the market every single day, every single minute, actually. Now, there are funds, okay? Now, funds are a little bit different because funds have sort of like a basket, okay? A basket of a whole bunch of different stocks. So instead of choosing individual shares that have no diversification, meaning if you only buy shares in LVMH and only buy shares in Target, that's it. You've got two companies. If they both tank, so does your money. Okay, there's not a whole lot of diversification and your portfolio has literally two companies in it. That's not really a great bet. Okay, so funds offer this basket. That's how I describe it, where you have so many different stocks. It's like an amalgamation, and if one goes up and the other goes down, they sort of balance each other out, and hopefully overall at the end of the day, the value of the basket grows. Now, within the basket, you've got two approaches. You've got active. These are actively managed funds, and then you've got passive. Can you see that? The sun is coming in real strong this morning. So active and passive. Active is real simple. Active is you've got a professional behind it, an advisor, an investment professional, and you're paying them a fee to manage your funds for you. So usually it's going to be mutual funds. Okay. Now, mutual funds are also a basket of funds that have all different kinds of stocks. And the primary goal of the professional that you're paying is that they try to beat the market. They try to outperform the S&P 500, for example, in the US. Do they do that often? No. The vast majority of investment professionals are not able to outperform the market on a consistent basis. They might have one lucky year, but when you're thinking about investing in the stock market, most of us are thinking long time horizon. So a mutual fund manager might have a good year or two, but over decades, they're usually not going to outperform the market. They're lucky if they can actually match the market. So there's a whole lot of research out there that tells us that they're not as good as they like to say they are. Otherwise, they'd all be rich themselves, okay? So mutual funds also come with fees. You have to pay the professional fees. So even if it's like a percentage or two, that's a lot of money over several years. If you're talking 20, 30, 40, 50 years of paying a percentage or two or more to this investment professional, they're eating away at your net worth. So your net worth managed through a professional versus managed by yourself at the end of the day will be a huge difference. Now, you might have peace of mind having just someone else be responsible for you. That's okay. It depends on your personality and what you prefer. I'm just calling out the pros and cons. Now, the passive approach is exactly how it sounds. No one is actively managing it. Passive is index funds, or sometimes you can do ETFs as well. So I'll talk about the difference in those two really quickly a little bit into the video. So index funds and ETFs. Can you see that? It's so sunny. I love sitting in the sun, but it's kind of blocking out my writing. So index funds, like my favorites, are the ones from Vanguard. I love Vanguard because of their low costs. You can purchase index funds or ETFs directly through the Vanguard website. If you were to do a Vanguard index fund that tracks, or any index fund that tracks the S&P 500, that means that they have that basket again, right? That basket of the 500 largest US public companies in that basket. So now you own a piece of 500 of the largest US companies, and that's your portfolio, okay? Very minimal fees because it's not actively managed by an advisor or professional. So you're going to save a lot on fees as well. So your growth and the compound interest will be stronger over time. And so the way to look at it is the active is stock picking. They're trying to figure out which stocks combined will do better than the S&P 500. The passive is, I'm just going to stick it in an index fund that tracks the S&P 500 and let it ride. Because historically, you're getting about 8 to 10% returns historically on average spread over a period of time. So again, if you're talking about retirement, most people work 40 years or more. So if you don't touch that money and you continue to add to it every month, every year, and you let the compound interest take place, most people, if you do this, the problem is most people don't do this, but if you do this and only put away even $500 a month from the age of, mid-20s throughout your working life, you will absolutely be a millionaire. That's just how it's proven to be historically, but most people don't do that. So that's a whole nother story. So there's the active and then there's the passive. And then there's the index funds and the ETFs. So an index fund, a lot of people confuse these two. So an index fund is something that can be traded at the very end of the day, at the end of the trading day. So you have set a transaction to purchase an index fund. It won't automatically go through right that second. It will trigger at the end of a trading day. Whereas an ETF, you can do that throughout the day as the price fluctuates. And you might say, I'm going to put it in at this price right this second, or I'm going to wait an hour or wait until midday, or, whatever. So it's just the timing. That's pretty much the main difference. Also, an index fund oftentimes has a minimum required amount. Sorry if you guys can't see this, the index funds. So I tend to do index funds, again, Vanguard index funds. And so the one that I do requires a minimum $3,000 deposit. So when I first started, this was a long time ago, I started with $3,000, and then you kind of keep going every month. The beauty of index funds is that they also allow you to automate. You guys know, if you watch my last video, I'm a huge fan of automating everything, automating bills, my saving, my investing, my charitable giving. I just like to put these things on autopilot so that it doesn't become a chore for me, and it's just really simple and easy. So index funds allow you to automate. Let's say you put in that initial minimum required amount, and then you say you want to put $1,000 in every month in perpetuity, or for the next 10 years, or whatever amount of time that you set. It will automatically do that. It will take that money out of the account that you link it with, whether it's your checking account or other account, and you don't have to think about it. Whereas with ETFs, you always actually have to put in an order to purchase the ETF when you want it. So it's not automated, okay? So for ease of mind, I do tend to prefer index funds. When I was much younger and I didn't have a whole lot of money to invest with, I started with ETFs. There's nothing wrong with ETFs. And the reason why I started with ETFs is because it felt a lot more accessible to me, because I didn't have thousands of dollars to start off my minimum required deposit. So that's pretty much it. Now, passive is low cost and immediately offers a diversification, right? And it tracks the market returns. It tracks the S&P 500. The active mutual funds through a professional has more expensive fees. They are stock picking, meaning they are trying to outperform the market. Oftentimes they're not able to, but sometimes they do get lucky. And then there's individual shares if you wanted to take a gamble and just choose 1 or 2 or 3 or 10 shares in specific companies that you're into. I do this sometimes because it's a little bit more fun. I will say this, index funds and ETFs, this passive approach is boring. It's boring. But I've learned over the years that the boring approach really works because it's steady. And yeah, slow and steady wins the race is kind of how it goes. If you want a little bit more excitement and you like the adrenaline rush and you're kind of a gambler, then individual shares in 1 or 2, 3 or 4 companies that you're into, that you've studied up, could be fun. I do sprinkle in, I'd say about 10% of my portfolio is individual shares just because I like to play. That's my honest answer. It's not really a logical approach. It's just I enjoy. I used to do day trading back in my 20s when I was younger, right after college, and the excitement and the thrill of it just hooked me. I did do that, and I've learned that that is really not, it's not the strategy for the long haul, although it was fun. So here's 10% roughly for me, and then about 90% of my investment portfolio in the stock market, I should say, is in index funds. But that's just me. I'm not a finance professional, by the way. I'm totally self-taught. I have been investing since about the age of 21 or so. And so it's been a little over 2 decades. And I just share this because I have a passion for financial literacy and empowerment, especially for women, because I feel like we sometimes get sidelined in finance conversations, and I really don't like that. So I share with my own sort of earnestness, but I don't share this as any kind of professional advice. I don't work in the finance industry, and I'm not a finance, accredited anything. So here, let me give you a shot of this. So that's pretty much it. I think I said this at the start of the video. If you can use tax advantage accounts like 401ks or IRAs and max those out first, I would do that and then open up a brokerage account, because why not take advantage of all the tax savings with the tax advantage accounts first and then do whatever you want to do with the brokerage. But even in the brokerage accounts, I still focus on the passive approach with the index funds. Again, that's me. It's been working out nicely. I plan to continue doing that over the next several years. So that is it. Let me know if you have any questions down below. I'll try to answer them as best as I can. And I hope you enjoyed this video. It was simple, quick, like I said, as I promised. And if it was helpful in any way, please give it a thumbs up, and I'll see y'all next time. Bye-bye.